You're listening to Ask the Expert on Sprott Money News.
Hello and welcome back to this month's Ask the Expert here on Sprott Money News. I'm your host, Jeff Rutherford, and on the line today we have the Senior Portfolio Manager at Tocqueville Gold Fund, Mr. John Hathaway. John, thank you for joining us today, sir.
Good morning, Jeffrey.
So, John, as usual, we have a number of questions from our listeners today. Not surprisingly, we have a number of questions about investing, particularly in precious metals and mining investments. So with that, let's get started. So our first question is, if the prices of precious metals remain blasé for the short to medium term, is there still room for long-term oriented management teams of miners to reduce costs and improve operating cash flow? Or have we already seen a significant portion of these efficiency gains and input cost reductions over the last few quarters?
I would say that there's probably further room. I don't think I could quantify that. It's quite clear that they've made significant progress on that front. In a lot of cases, it is a combination of good luck and hard work. The good luck, obviously, is lower oil prices, lower energy costs, and lower currencies versus the U.S. dollar gold price. So that's been a huge contributor. But most of the companies we follow are highly conscious of the need to do some belt tightening, and I think there's probably still some benefit to come, but I don't think it will be dramatic.
So, John, moving over to precious metals again here, we have a question in regards to silver. Now, the question here is, Citi's $4 trillion commodity position has been reduced to millions as of June. What does this say about where the silver markets are heading? Is it possible, John, the illogical price of silver, which is below the median cost of production, break free from its imprisonment? If so, can the banking industry survive a higher silver price given the apparent extreme position?
My view on silver is that it probably doesn't do anything without leadership from gold. And so I've always focused on gold, but recognize that silver has the same precious metal monetary characteristics as gold. But the things that you just mentioned relating to large financial institutions possibly being underwater on their hedge book, I think that could be a contributing factor on the upside and maybe give a lot more octane to an upside move than would otherwise be the case. But I don't think that silver can make headway on its own without leadership from gold.
Now, another interesting topic that always comes up with our listeners is the idea of mining and investing in mining companies. So I guess generally speaking, this question is, please provide the best argument in favor of investing in precious metals mining companies, as well as the best reason to stay away from this particular asset class. Good question.
I don't think we have enough time. Look, this industry has committed hara-kiri as far as I'm concerned, and I'm talking now about the industry. They have carpet-bombed investors with paper in the form of new shares, increased debt, and the dilution that has taken place during the rise in the gold price from where it was at the beginning of the last decade to the peak in 2011. The dilution has been enormous. So it's no wonder that gold stocks are hated. Now, having said that, there are managements and companies that have actually added value and haven't committed the sins that I've just described. They paid attention to share issuance, they've avoided debt, and they've added value by building mines. And those are the companies that we have in our portfolio with Tocqueville Gold. So there's no question in my mind that when the turn does come in the precious metals markets, and that's another conversation, well-chosen gold stocks will provide a much more dynamic response to that than, let's say, a broad index. Pick your index. It could be XAU, it could be HUI, or some sort of passive ETF instrument. And that's the argument for active management in precious metals. So, yeah, the industry's done a bad job. Maybe they've learned some lessons. Time will tell. But there have been companies, and we think we own a good number of them, and hopefully not too many that don't meet this qualification, that have done a very good job in terms of adding value, keeping share counts low, turning off the phone from investment bankers from Toronto, all the things you need to do to add value. And those are the stocks to own. So that's my sermon on gold stocks.
So moving over, again, talking about the idea of prices being artificially depressed, what do you see as the most likely catalyst to allow the miners to break out of the artificially imposed depression in this sector?
Well, it's really very simple. We need to have a bear market in stocks. You saw kind of a foretaste of that in the third quarter, and obviously since the end of the quarter, we've had central bankers in warp speed mode trying to juice up financial assets. But that's a game that's becoming more and more obvious. But the short answer to the question is that the catalyst will be a bear market and bad experience in both stocks and bonds. And the reason that would drive gold prices and silver prices much higher is that the financial markets are a creation of central banking. And so almost by definition, it's a reflection of confidence in the behavior and the actions of central bankers. If that experience, i.e. a bull market, turns to adversity, which I think is inevitable, then you will see loss of confidence in central bankers, long overdue and certainly well-deserved. And people will look for answers. And one of those answers, unquestionably, will be precious metals. So that's kind of the chain that I see that has to occur. And, beyond that, the markets are rigged. We know the markets are rigged. All markets are rigged. You start with interest rates and go right on from there. The mechanism of rigging is, in the case of gold, you have synthetic paper, which way outweighs the amount of physical gold that's traded on a daily basis or a yearly basis. And, as annoying as it is, these same paper traders, which played a large part in driving the gold price down at a time when demand is starting to exceed supply, will turn on a dime, and they'll get behind higher prices because they're basically high-frequency traders and algorithmic traders. And, if there's conspiracy involved, I don't know who Dr. Evil is. I'm sure there's one out there. But, I think the bigger story is just that the gold market has been so financialized by synthetic instruments that we're at the mercy of whichever way that school of fish decides to swim. But again, if we have a bear market, and I think that's somewhere in our future, maybe just around the corner, these algos and HFTs will get behind gold in a big way. And I think, all that paper trading that's been the bane of all of our existence for the last 4 years will suddenly, you have to be careful, the company you keep, but they'll have a big to-do with driving prices higher. So there is manipulation in all markets. Why should gold be exempt? It's hard to fully understand. It's circumstantial as to what the motives are, but it's quite clear that the last thing Janet Yellen or Mario Draghi or their counterparts in Asia want would be a huge gold price. $3,000 or $4,000 gold would kind of say checkmate for public policy. So they don't want it, and one way or another they're resisting it, maybe through machinations with synthetic gold trading. I really don't know. But $3,000 or $4,000 gold would be an indication to anybody with half a brain that public policy on all fronts is bankrupt, and that's why investors should stay with gold stocks, and the vindication, I think, will be well worth the pain.
Now, John, we know for a fact that the mainstream media really hasn't been painting a very pretty picture of gold or precious metals for the longest time. So the question is kind of based around that, and likewise how that kind of frames this for financial advisors as well, too. So the question is, why do you think that most other financial advisors steer clear of precious metal miners when they are clearly and objectively the most underpriced asset class in the marketplace? Is it because they still believe that buy and hold is dead? Or do you think that they have been deceived by all the anti-precious metals propaganda in the mainstream media?
Oh, I think it's probably a combination of that. I find that, the constituency for gold in a bull market for stocks gets smaller and smaller. So you have to sort of respect the sensitivities of a financial advisor who might have had a decent commitment to gold, and it's killed him in terms of performance. And he's hearing it from his clients. So I think that's the dynamic you have going here. And there's no doubt in my mind that when the worm turns in the gold space, these people who are sitting on the sidelines will be there front and center as buyers and new money coming in. As far as the mainstream media and its sort of anti-precious metals campaign, that certainly has a contributing effect. There's a huge lack of understanding of the role of gold in a portfolio, how it can behave in an uncorrelated fashion to sort of enhance returns over time and protect wealth. That all goes by the wayside when you've been in a 4-year downswing for the gold price and for the silver price. And that's sort of accentuated by the piling on effect of the mainstream media. But those media guys will get on board as well. I've seen it before. In fact, you can count on them to call the top just by turning bullish on the front page. So, I'm glad that they're aligned in a negative way right now.
So, John, let's take a moment and talk about in terms of how other markets kind of affect gold and gold stocks as well, too. So the question is, equity markets appear to be firming up again during the past couple of days. Is this temporary? And what does this trend mean for gold stocks?
In the short term, it means that my idea that a bear market to drive gold prices and gold stocks higher has yet to be tested. As I said, we saw a little taste of it in the third quarter. We'll see where this current central bank induced rally goes, how long it can last. So I don't know how long it can be sustained. I would say that the general trend of corporate earnings is down. Top line revenue growth is flat to down. Margins are at all-time highs. So all the things you would expect to see at a market top are taking place. But the one thing that sort of trumps all of that, which is fundamental analysis, is the desire of central banks to jam the shorts and drive stocks higher. And that's what's taking place right now. I guess, and I should have learned this lesson 40 or 50 years ago when I came into the business, don't fight the Fed. But now we're fighting not only the Fed, we're fighting the European Central Bank and their counterparts in Asia, and they're all sort of doing what they're doing together, passing the baton on who can be the most radical in their monetary experimentation. Hard to say how long this can go on. But what I like about gold is that we've been through some very tough years here, and it's beginning, and I'm knocking on wood as I say this, beginning to sort of ignore and show resistance to the stock market making new highs. I view that in a small way as being a positive sign of base building and maybe all the weak hands having been shaken out. So from this point on, I think for those of us in the precious metal space, it's more of a waiting game. I don't think there's a lot of downside risk. I think it's how much more time and patience is it going to take for the things that I've talked about, and probably some things that I couldn't even begin to think about, fall into place that will make investors decide they want to have more gold rather than either none at all or less. So kind of a waiting game as far as I can see it from here on out.
Mm-hmm. So, John, here's a question, I guess, around specifically the Tocqueville Gold Fund itself. So what our listener wants to know is, what are your fund's top gold positions and why? Likewise, which are the most interesting companies that you are following but do not yet own?
Well, let me talk more about our process. We have a team that consists of myself, my co-portfolio manager, Doug Groh, who's very experienced in precious metals, has a background in geology. He's been on the team for over 10 years. And then we have two younger analysts, both Canadians, for what it's worth, but very, very good analysts. And we spend a lot of time doing due diligence. That includes visiting mines, spend a lot of time in meetings with management. They come to New York looking for money or just checking in. So we have a great dialogue with the executive suite. And so our ability to conduct due diligence is very, very high. And that's where we start. And our turnover is low. So what we look for are companies that are adding value. And I'll give an example or two before I finish. Sometimes that value that's being added is not reflected in the share price because, as we're all aware, gold has been in this lengthy correction since the peak in 2011. So, there can be progress made, either drilling or mine building, sometimes in M&A, that doesn't get recognized in the market. But that's where we start. I would add that our turnover is very low, so we don't trade in and out. And so the holdings that we have as core holdings today haven't changed a whole lot from where they were 3 or 4 years ago, and we'll certainly sell things that seem overvalued, at least at the margin. We'll sell them and recycle them into things that we think offer better risk reward. So, in that sense, it's a fairly conventional approach to portfolio management. As far as our top holdings go, they are publicly disclosed as they must be. So if I forget some of the top names, it's just because I can't remember them in this conversation. But our largest holdings include names like Detour Gold. We have a big exposure to royalty companies, the usual names, Franco, Royal Gold, Silver Wheaton, and now, more recently, Osisko. One of our favorite big cap holdings is Goldcorp, which I think has done a very, very good job of navigating these difficult times, and they have a nice growth profile and management that we think highly of. So those are some of the names. In terms of themes, which would be like what would we like to own more of that we don't have today, we are quite enamored with the more entrepreneurial mid and smaller sized companies that are buying assets from distressed sellers, namely big cap companies. I don't want to go into names, but there are forced divestitures because of excessive debt on balance sheets of big cap companies into a very weak market. So it's a buyer's market. So we see value being created by, just to throw out a name, Evolution Mining, which is an Australian company. We like Premier Gold, another name that we think. We like the recent Alamos acquisition. So I'd say the theme that we're seeing this year is smart guys who've kept their balance sheet in decent shape, kept their powder dry during this period, and are now taking advantage of the distress of some of the bigger cap companies that are basically in a stripping mode to streamline and reduce debt burden. So that's named a bunch of names, but I recommend that anybody trying to get a full picture of our exposures to go to our website, and there our top holdings are all there for everyone to see.
So, John, sticking with the idea of companies, the next question is, what do you think of the all-in sustaining cost metric that companies are increasingly using? Is this a valid metric? Which companies are performing the best in this regard?
I'm not sure that it's a valid metric. I like it better than cash cost because at least it shows that the industry is just hanging on by its fingernails from a sustainability point of view. It's very subjective, so it is probably flawed, but it's not as flawed. The metric the companies were using going into the top in 2011, which was cash cost, which was as phony as it gets. First of all, I think that you can't just stop with a metric that managements present in a slide deck at a conference or on their website, which doesn't tie back to the financials. And what's really lacking in this industry, it's probably lacking in many industries, but certainly from my perspective, is the metrics that are presented really don't tie back to financials. And so one person's all-in sustaining cost is not the same as somebody else's all-in sustaining cost. And that, again, is because there's so many subjective inputs, different accounting practices, and that's my major beef. And that's something that we pay attention to in our analysis. We look well beyond those metrics. So, yeah, the all-in sustaining cost is a better metric than cash costs, which was widely used before all-in sustaining costs came into greater popularity. But even that metric really falls short of proper financial disclosure. And for that, I think you just have to go to the financial statements, read the footnotes, look at the accounting, and that kind of thing to get a proper sense of what's being represented. We look at all-in sustaining costs only because everybody else does, but we go well beyond that in our analysis.
So, John, going back to gold now, we wanted to take a look at gold from a historical perspective. So the question is, what lessons do you draw from history as to how gold might perform during a time of deflation? For example, gold stocks outperformed the index in the wake of the market crash of 1929 and ensuing Great Depression. Could this happen again in times of deflation?
The answer is that gold always performs well when there is financial disruption, whether that's expressed in the form of deflation, as it was in the 1930s, or inflation, as it has been expressed more recently. And by the way, if you look at the gold price in any other currency than the dollar, you would thank your lucky stars that you had it, because your local currency is toast. So gold basically, and this is what so many don't understand, and it's just really just kind of missionary work for those of us who like and advocate precious metal exposure. And that is that gold is property that exists outside of the financial system. It's the sort of thing that would provide liquidity when the exchange is closed down or when the banks are shut down. So it's a reserve asset, and though there might be some that would argue, well, you know, I have paintings, I have antique sports cars, I have homes here and there that are, you know, they're my hedge against inflation or deflation. But none of those are liquid, and the bid and ask on Picasso's or you know, Austin Healey's or whatever you want to mention is just wide enough to drive a truck through. But gold is a liquid 24-hour-a-day market. You can always get a bid. You can always buy it, and there's no other non-financial asset, and I'm including silver in this. Silver also has the same virtues as gold in this respect. But there's nothing else that really gives you reserve buying power. And I'm not talking about the kind of buying power you would use to go to 7-Eleven or whatever you have in Canada to buy a quart of milk. That's kind of an idiotic construct for why you would have gold during extreme events. The idea of having gold during periods when you have a financial meltdown of any kind, whether caused by inflation, deflation, geopolitical, all the things that one can imagine, is that it gives you the ability to take advantage of distress and, you know, maybe buy the Standard & Poor's when it's trading at 2 times earnings, when nobody else has any buying power whatsoever. So that's the reason to own physical gold, and that's the attraction that it should have at the end of the day. It's wealth insurance, and unlike the view, that's very different than the view that so many have that it's basically a trade. You know, you buy it at $1,100 an ounce and you sell it at $2,000 an ounce, and that's fine. You know, I'm not saying that that's not a good reason, but the deeper reason, and getting back to your question about history, is that over time, and I'm talking centuries now, and of course most people don't think in centuries, they think in terms of next week, but from the perspective of a wealthy family, from the perspective of a pension fund, a university endowment, some component of gold makes all the sense in the world, because the time frame for those kinds of investors is generations, not a 6-month trade.
So, John, we're getting to the end of the interview here now, and usually our interviews always end up on the same note. And the question is, the golden question, no pun intended, is what is your immediate outlook for gold prices and why?
First of all, my record as a market timer is probably as bad as anybody else's in this space, but I'll make a couple of observations and hopefully they'll be helpful. It looks to me like gold is firming up. You have, and I haven't checked it these last couple days, but over the last several weeks we've had some mild backwardation, the spot price being a little bit higher, a few dollars higher than the most active future. That's usually constructive, signifying maybe a little bit of tightness in the availability of physical metal. You know, we've seen this before as we've been heading down over the last 4 years, but I just point that out as at least a short-term constructive sign that the downside risk is somewhat limited. Let me just add a couple things to that. These are observations. I see, I'm not a big technical analyst, but I do get various services, and I'm beginning to see technical research, whether it's based on Elliott Wave or the more traditional off-the-shelf kind of talking MACDs and stochastics and that kind of thing. That is turning more constructive than I can remember in at least a year. So, you know, the backwardation, technical research, you know, which I do not generate myself, and I only look at it like I look at the weather forecast, seems to be a little more constructive. So those two things, I would say, might suggest that the timing is positive, a little more positive than it has been. Let me just add one other thought, and that is, if you look at not just people like me or Eric Sprott, who, we've been in the gold space for a long time and we're advocates, but if you look at the views of people who might be agnostic, who are investment luminaries, and I'll just mention three: Stan Druckenmiller, formerly of the Soros Funds, Paul Singer of Elliott Advisors, and Seth Klarman of the Baupost Group. All of them tremendously successful investors who have made fortunes away from gold, who are, could be market neutral, and they could invest in anything. Shorting, what I'm saying is that they're all over in terms of their mandates. All three of them are very constructive on gold right now. And there are others that I could mention, but those are three that are quite famous, well known, easily researched. So let me mention the three things that are hopeful signs. One is, and I'm just reviewing what I just said, backwardation, a somewhat positive short-term sign. Technical research turning more constructive. And then lastly, big thinker, successful investment luminaries, some of whom are much better at market timing than I've ever been, are saying that this is a good place to be right now. So no promises, but maybe there's a faint, dim glow at the end of the tunnel, and maybe it's the end of the tunnel coming soon to a theater near you. And hopefully that's the case, because we've been through a really tough 4 years, particularly these last two. And long term, I'm, just unrepentantly bullish, but I'm with so many others who've been in that direction and without any sort of vindication for several years. I do think we're starting to see some glimmers, some positive glimmers that the worst is behind.
Again, we've been speaking to John Hathaway, who's a senior portfolio manager at the Tocqueville Gold Fund, and we urge our listeners to go to Tocqueville.com and likewise continue to read some of the phenomenal work that John has published in numerous online publications in the financial world. And with that, we'd like to thank John Hathaway for joining us today. Thank you, John, for joining us today. It's been a pleasure speaking to you, sir.
Thank you, Jeffrey. A pleasure on my part, too.
And to our listeners, thank you for listening. This is Jeff Rutherford for Ask the Expert here on Sprott Money News. Have a great day.